The 2025 bull market continues with the S&P 500 of 16.67% year to date. And really since coming out of fall 2022, the market has been on a rocket ship aside from this tariff sell-off. And the S&P 500 is up 37.2% from those April lows. And this growth is primarily due to the large big tech companies which make up the S&P 500. As an example, Nvidia is 8%, Microsoft is 6.7%, Apple is 6.6%, Amazon 3.7%, Meta 2.7%, Broadcom 2.7%. We have the different classes of Alphabet stock at 2.4% and 1.9% respectively, and Tesla at 2.18%. And it's primarily these big tech companies which have been driving up the market. This week, a large chunk of these big tech companies just reported earnings, and they backed it up. The growth of these companies is truly impressive, and a large part of that is the new trend around AI. Every month on this channel, I give you an updated look at my long-term dividend growth stock portfolio. This account has a pretty interesting combination of high-growth big tech companies, and I also have some high dividend yield stocks when I find an attractive opportunity. This account, along with my two other investment accounts, have performed quite well so far in 2025. And a lot of that is due to buying those big tech companies in the April sell-off. As an example, I built this position in Alphabet, the parent company of Google, and so far I have a 73% total return. I also added to my stake in Microsoft during that time, but about the majority of this holding back in fall 2022, and overall I have a 97% total return. In this video, I'm going to dive into the latest big tech companies, as well as all the stocks in my portfolio that reported earnings last week. I'll also provide a full update on my long-term dividend growth stock portfolio, what stocks I've been buying over the past month, and why I am hitting record high dividend income. With that said, let's roll the intro and get into this month's portfolio update video.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. And sorry I haven't been posting much over the past month, it's because I have my biggest update ever for dividenddata.com, which will be rolling out in the next few weeks. Hopefully faster. I'm working my hardest. I've been calling this secret project, and I'm so excited to share it with you guys. I will be making a ton of content once it's out, and you'll see a lot more of me over here on YouTube. And if you want to use the stock research and portfolio tracking tool I show throughout the video, it's all available at dividenddata.com. The link is in the description and pinned comment of the video. So let's dive into my dividend portfolio. The current total value is just under $273,000, with $163.4 thousand invested, giving me a 67% total return. My top holding is Hess Midstream, ticker symbol HESM. I currently have $72,000 in that stock, and this is the company I have loaded up and bought a ton of over the past month and really 2 months. If you go back and watch my last portfolio update, I do a full deep dive into that company. It's around a 45-minute video. So if you want my extended thoughts and analysis, please go reference that video. I will not be going that deep into it in this video. Although a little bit of a spoiler, this is the stock that I bought more of this month. My number 2 position in this account is Microsoft, ticker symbol MSFT. That's $60.4 thousand. Number 3 is Alphabet, ticker symbol GOOGL. That's $44.5 thousand. I'll be doing a pretty good dive into both of these companies and their latest earnings. My number 4 holding is Visa, ticker symbol V. That's $34,000. I have a 42% total return. And then you'll notice one stock has come down on the list, and that's the Altria Group, ticker symbol MO. And that's due to the company selling off nearly 10% after earnings. I'll dive into that and give my thoughts. But also, I did some rebalancing in this account. And a few weeks before the sell-off, I allocated some of that money into Hess Midstream. I'll be going over all of my buys and sells in a few minutes. Next up, I have ExxonMobil, ticker symbol XOM. I have had this holding since 2020, and I have not added to it other than reinvesting dividends. I have a 149% total return. And then rounding out the list, I have MPLX. This is $14.5 thousand. I have a 5% total return. And this is another high yield, high dividend growth midstream oil and gas stock that I've been adding to. MPLX and Hess Midstream I'm looking at as being core high yield pillars of this account. So overall, you can see I am highly concentrated in my top holdings, and I have 75% of the account in just 4 stocks. Here you can see my projected dividend income this generates. It'll be $11,238 a year. I have more than doubled this in 2025, and that's largely due to me finding some great high yield opportunities I have dove into. This gives me $2,800 of quarterly dividends. My monthly dividend income is now $936 on average, which is about $30.79 a day, or $1.28 every hour. And this month of November is about to be my biggest month of dividends ever by far. I'm projected to get $1,924. That'll be $1,615 from Hess Midstream and $308.93 from MPLX. And I'll dive into a little bit of why I think these will be huge compounding machines in a second. My other months are projected to be $384 in December. And that's when I have Microsoft, Visa, Google Pay, plus ExxonMobil. And then in January, I'll get paid $500 for my position in the Altria Group, which I will be reinvesting. I try to reinvest all of these dividends, by the way. Eventually, I might take them as cash and purposefully reinvest depending on the opportunity. But right now, I find it pretty simple just to auto reinvest via DRIP. If you don't know what that is, many brokerages offer that you can just automatically set for dividend reinvestment. And you'll notice one thing looking at my account. My highest dividend payers are the highest yielding dividend stocks. But I think there's a lot of misconceptions with some high yield dividend stocks. One, a high yield does not necessarily mean a company's dividend is at risk. Two, you can actually find some high yield companies that continue to grow their dividend payments reliably at a high rate. And that's what I found with Hess Midstream and MPLX. As an example, my yield on cost with Hess Midstream is 8.77%, and it's 8.67% with MPLX. And both of these companies, just in the past week, raised their dividend payments. Hess Midstream's increased their dividend by 2.4%, and they've been doing quarterly increases. So if we go and take a look at the dividend data for Hess Midstream, you can see the dividend has grown at a 5-year compound annual growth rate of 11.31%, and they've been raising it every single quarter. Their latest increase of 2.42%, the quarter before that was 3.83%, the quarter before that 1.23%, before that 2.42%. You get the gist. MPLX also just raised their dividend by 12.5%. And if we look at the dividend data for that company, you can see there's a 9.38% 5-year CAGR. And the company has now done back-to-back 12.5% increases. And that's insane when you consider this as a company yielding over 8%. I've done deep dives into both of these companies, and I do think this is sustainable growth to continue in the future. Also, some of my lower yielding stocks are great dividend growth companies like Visa, which just raised their dividend by 13.6%. So I had a big week of dividend increases in my portfolio. And so this combination of dividend growth and dividend reinvestment that creates this dividend snowball effect that us dividend investors love. If we take a look at my earned dividend history, you can see I've earned $20.1 thousand all time, $4.4 thousand in 2024, and so far I've earned $4.68 thousand in 2025. And this is going to go way up in 2026. Last month, I got paid $645 in dividends, and that was from the Altria Group and Salesforce, and that month is coming down as part of my rebalancing. If you want to know the logic behind my rebalancing and you missed last month's video, go and watch it. It's a huge deep dive into my thoughts around this whole rebalancing process. It's just a continuation of that same process. Speaking of that, let's get into it. Over the past month, I bought 457 shares of HESM at a cost per share of $31.91, amounting to $14,581 of total cost. I bought this at a 9.46% dividend yield on cost, increasing my annual dividend income by $1,380. I funded this with some rebalancing. That included 116 shares of Altria Group at $65.15. That was $7,500. And if you'll notice, the stock did come down 10% from that price. I couldn't necessarily have predicted that, but it worked out in that case. It does not always work out when you do these kind of things, though. Later in the video, though, I will give you my updated take on the Altria Group. If you remember in my last video, I mentioned that they were starting to look a little overpriced, but now with that 10% sell-off, it's starting to look more reasonable. I also sold 21 shares of Visa, ticker symbol V. That was at a cost per share of $343, $7,200 total cost. And that's continued rebalancing that I did in the prior month. This past week was a big moment in the market because if you've been investing for a long time, you know that earnings drive the long-term value of stocks. So every time a company reports their earnings and gives forward-looking guidance, that can really impact the market. Last week, most of the big tech companies reported earnings. And as I mentioned at the start of the video, they are becoming a larger and larger percentage of the market if you view it through the popular indexes like the S&P 500 or NASDAQ 100. And for this part of the video, I'd like to thank our sponsor, Earnings Hub. They have an amazing earnings focused tool, which gives you breaking news and you can listen to earnings call and you can see a full calendar. If you want access to it, it's available on the sidebar of dividenddata.com. Just click earnings calendar and boom, it opens up and you can go week by week and you can see all of the different companies reporting, whether it's before market open or after close. You can even add to a watch list. Like as an example, I have Hess Midstream reporting on Monday, so I have that on my watch list. You can also go back and look at historical results, play earnings calls. And if we go back and look at last week for big tech, I'll be diving into how each of the different companies did. And this is now my preferred platform when I do listen to earnings calls. If you want to try out Earnings Hub, use the link in the description and pinned comment of the video and create an account so they know we sent you. So of my top stocks that reported earnings last week, we had Visa, ticker symbol V. That was Tuesday after market close. They beat on both revenue and earnings per share expectations, but the stock sold off in the days following. In a similar vein, Microsoft reported Wednesday after market close. That was a big day for earnings. We had Microsoft, Meta, and Google all reporting after the bell. Microsoft had a big beat, 3% over expectations for revenue and 12.8% over expectations for earnings, and 12.8% over expectations for earnings per share. Came in at $4.13 for the quarter. Alphabet also had a huge beat. They beat expectations on revenue by 8.8% and earnings per share by 26.43%. And I'll dive a lot deeper into those big tech companies. But also in my account, we had Altria, ticker symbol MO. They beat on revenue and slightly on earnings per share, but the stock sold off nearly 10%. So I will give you a deeper dive into that as well. And finally, I had ExxonMobil report on Friday. They beat on both revenue and earnings per share, and there wasn't any major price action there. So let's start with big tech. We'll go with Microsoft first. I have an AI analyst built in on dividenddata.com where you can ask different questions. And one of the most popular ones is to summarize the latest quarter and earnings call for a company. So I did a little summary here for you guys for Microsoft, although I did actually listen to the earnings call for this one because it's one of my bigger companies and I'm a nerd and into that. So overall, Microsoft's revenue was up 18% year over year, coming in at $77.7 billion for the quarter. This was actually their Q1 2026. They're on a little bit of an accelerated fiscal schedule. So they're starting their 2026 fiscal year now. And if you've been following Microsoft stock, it's all about the cloud business with them. That includes their cloud-based subscription software, but also their cloud services, most notably Microsoft Azure, which is one of the dominant cloud platforms. They're second place behind Amazon Web Services, but they are growing much faster. The third place competitor is Google Cloud, which we will cover when we talk about Google stock. Overall, Microsoft Cloud revenue was up 26% year over year, coming in at $49.1 billion in the quarter. And a large chunk of that is due to Microsoft Azure, and Azure revenue increased 40% year over year. And this is quickly becoming their largest business segment, growing at that rate. Microsoft operating income increased 24% year over year to $38 billion. And here we can see a little bit of a growth breakdown between their various business segments. We have productivity and business processes. This is their software side of the business. So it includes things like Microsoft 365, that increased 17% year over year. And then intelligent cloud, which includes Microsoft Azure, but then also their legacy server business. That revenue grew 28% year over year. And more personal computing, which includes their PC hardware and also their gaming segment, that revenue grew 4% year over year. So the real growth business within Microsoft is their cloud business. And when we're talking about that, we're talking about the cloud part of productivity and business processes and the cloud part of intelligent cloud. And the performance for Microsoft is fantastic. Another big thing with analyzing stocks is the outlook the companies give in the future. So with Microsoft for Q2, they're expecting revenue between $79.5 billion and $80.6 billion. So that'll be between 14 and 16% year over year increases. And the big one with analyzing Microsoft is the Azure growth rate. And they gave a projected growth rate of 37% for Q2. So this is incredible growth for a large business. And when you're analyzing these big tech companies and the investment in AI, a big thing is the increase in capital expenditures. This is true at both Microsoft and Google. And the company is continuing to increase their capital expenditures. This somewhat dwarfs their free cash flow as they're reinvesting a lot of the profits. But when you see a business growing 40% revenue year over year, it makes a lot of sense to make those investments right now, especially when you consider the competitive dynamics of where these companies are, and they need to keep the top market position. And as we look at the stock analysis for Microsoft, it starts to become pretty obvious why this is one of my core holdings. The company's growth is reliable at a high rate. And this is why I love these data visualizations to zoom out over a historic time period so you can really see the trends in action. The earnings per share for Microsoft continues to climb. This latest quarter of $4.13. You can see that over the past 5 years, the company has far more than doubled their earnings per share. And this is set to continue given the outlook. As an example here, we can see the analyst estimates for Microsoft stock. They're projecting double-digit earnings per share growth well into the future. And the same goes with revenue growth. Microsoft revenue has grown at a 12.7% 10-year compound annual growth rate. And this is accelerating with the recent year being 14.9%. Net income per share is growing at a 24.8% 10-year CAGR and a 5-year CAGR of 18.68%. So although Microsoft is making more money than ever, they are spending more in capital expenditures, and they have to do this for these large AI data centers. So their free cash flow growth is somewhat stunted. 5-year CAGR 10.14%, 3-year CAGR only 3.49% because they've been spending so much more money. Now, it should be noted in the latest quarter, they had $3.45 of free cash flow per share, which was a record for them. And year over year, that was like 33% increase. Everything about Microsoft is growing. You see their assets, their shareholder equity continues to hit record highs. Their cash on hand is very strong, although they were spending more of it for this capital investment. But at any point they want, they can allow their cash position to grow, as it has been over recent quarters. They have negative $41 billion of net debt, meaning they have far more cash than they do in total debt. And it's this strong business why Microsoft is able to pay a growing dividend as well. They're able to do this while reinvesting heavily into their business. The dividend's grown at a 10-year compound annual growth rate of 9.72%. That's a 3-year CAGR of 10.2%. The most recent dividend increase was 9.6%. And this is very sustainable. The dividend is only a 33% free cash flow payout ratio, and it's 23% based on earnings per share. In a similar vein, Alphabet is one of the best businesses in the world, and that's why it's a core position in my account. And I'll dive into the latest earnings report, but again, just look at the earnings per share growth over time. They just hit record high earnings per share of $2.87 in this quarter. So I'll summarize the latest quarter here for Alphabet stock as well. The key difference to understand here between Alphabet and Microsoft is that Alphabet primarily is an advertising business. Google Search is the cash cow. It is their dominant money printing business that they use to reinvest and fund all their other businesses. But some of Google's other businesses have started to become very high revenue, high growth, and some very profitable. Overall, the Google Services segment saw 14% revenue growth year over year, hitting $87.1 billion of revenue. And primarily, this is Google Search, but it also includes YouTube advertising and their subscription business. Here, I opened up their actual earnings report to help you guys see this. So here you can see Google Search, by far the largest, $56.5 billion. YouTube ads growing at a high rate, up to $10.2 billion in the quarter. And then their Google Network. This is the display ads on websites that you'll see that are powered by Google Ads. That business is basically flat, and probably unless they adapt it in some way, won't be a growth business ever again. And that represents Google advertising, which is the overwhelming majority of Google's revenue. And by the way, advertising is a volatile market, and there are these boom and bust cycles with it, which is why if you look at Alphabet's earnings, despite it being a fantastic, amazing business, it does have more frequent dips, and the chart's not as smooth as something like Microsoft. Microsoft is primarily subscription or recurring contract-based revenue. It's for that reason that Microsoft trades at a higher multiple than Google. However, Google does have their own subscription business, which is growing. As you can see, that was up to $12.8 billion, up from $10.6 in the prior year. And that includes things like YouTube Premium and their like Google One subscription, which bundles a bunch of things together, plus their new AI, Gemini, and all that. But a lot of people don't know this. Google is also one of the largest cloud providers, and that is growing very fast. Google Cloud increased revenue 34% year over year, hitting $15.2 billion in the quarter. And they started way behind Microsoft Azure and Amazon Web Services. But they are growing at a high rate, and it is now becoming a profitable business segment. Operating income surged by 85% to $3.6 billion in the quarter, and they have an operating margin of 23.7%. This business used to be a money loser a few years ago. and this growth is set to continue. Google Cloud has a backlog of 46% sequentially and 82% year over year to $155 billion. And that is driven by the enterprise demand for AI. And for a long time, people were saying Google was dead, and the reason was going to be from AI killing their search business. I've been covering this for over a year. If you've been watching my videos and know my thoughts, I don't think that's happening. It's overstated. Their search business is actually growing. They're integrating AI into all of their Google products and Google Search. And they have one of the best businesses in the world to be able to invest at a large scale into AI data center infrastructure. So I think people need to be shifting their view around Google, and I think it's already starting to happen, where you view Google as actually one of the best AI businesses in the world. They are a leader in that space, and to the degree that they are disrupted, they will be leading it and disrupting themselves. And in this AI race, it requires a lot of capital investment, and one of the only companies able to fund this, aside from Microsoft, is Google. They raised expectations for annual capex at $91 to $93 billion. The prior estimate was $85 billion, and they're expecting a significant increase in 2026. And overall, I view Alphabet as a long-term, very high-quality growth company. This will be a core position of mine well into the future, and I wish I loaded up even heavier back in April. Over time, I will likely dollar cost average in if I don't have better opportunities, and if there is any dip, I will try and go heavy into Alphabet and Microsoft. As we take a look into Alphabet, you can see that their revenue per share is growing at 19.2% 10-year compound annual growth rate. Net income per share is growing at 22% 10-year CAGR. And similar to Microsoft, they've been having increased capital expenditures, but overall free cash flow is still growing 21% 10-year CAGR, 3-year CAGR 5.58%. And the Alphabet balance sheet is fantastic. They've been growing their assets far more than liabilities. Shareholder equity is hitting all-time highs of $386.8 billion. They have an incredible cash position, currently at $98.4 billion of cash and short-term investments. They have negative $64.7 billion of net debt. And even though Alphabet is reinvesting heavily in the future, they still have such a great business, they can reward shareholders as well. They are buying back stock, and they have started paying a dividend. And just in the past few months, they had their first dividend increase of 5%. This dividend is small right now, but it's incredibly sustainable, under a 10% payout ratio. So as we go back and look at my portfolio, you can see Microsoft and Google are core positions. I plan on growing these in the future. But there was one more company that a lot of dividend investors like to own and has been a staple of my account for a while. That's the Altria Group, ticker symbol MO. They reported earnings and the stock sold off nearly 10%. In fact, it's down 14.25% over the past month. So what happened? Why is it down? And am I worried about it? In short, based on the fundamentals, I'm not worried about it. It's pretty much in line with what my expectations were. My main concern was actually about how high the price was because it had run up so much in recent years. This is a slow growth company with, as you can see, flat to declining revenues depending on the quarter or year, and slow growing earnings per share. So this is a company you need to buy cheap. You can't be chasing these slower growth companies. As an example, there's a reason you can pay a 30 times multiple for Google or Microsoft, but you can't do that for a company like Altria. It was getting close to a 13 or 14 times multiple. That's getting pricey for them. I was buying it closer to a 7 and 8 times multiple. So in my opinion, I don't think it sold off that much due to fundamental reasons. We can kind of nitpick and look for stuff, but I thought it was just priced a little bit on the higher end, and probably the market was just coming back to reality. And that's part of the reason why I felt comfortable rebalancing at that $65 mark. So if we take a look at MO, you can see their adjusted earnings per share came in at $1.45 for the quarter, up 3.6% year over year. And for the first 9 months of the year, we're up 5.9% year over year for earnings per share. And with this company, again, they're not growing cigarette volumes. They are growing volumes in some of their smaller businesses, but it'll take a long time for them to become the big chunks of the company. So when you're investing in this company, you're doing it based on expectations for slow earnings per share growth, which is going to be from them raising prices on their products, and then slow, reliable dividend increases. That's where your return is going to come from with Altria. So you need to buy with that in mind. Everything's pretty much fine for Altria. I don't know what people's expectations were. 2025 full year adjusted earnings per share, they narrowed their guidance for that from a range of $5.37 to $5.45. That's 3.5% to 5% growth, which is pretty much fine for Altria. I'm not expecting more than that. The company also has been repurchasing shares, which is nice. They spent $112 million repurchasing at an average price of $6.13. And they announced when they reported earnings that they authorized existing share repurchases from $1 billion to $2 billion, and that will go through fiscal 2026. So that's nice. That's another way they're returning capital to shareholders. But the majority of these shareholder returns are dividends to shareholders. They just had their 60th dividend increased in the past 56 years. That was a 3.9% increase. And they maintain their goal of targeting mid-single digits dividend per share growth annually through 2028. So I personally think this sell-off for Altria was much needed. It's a much more fair price now. I actually feel more comfortable owning it from here. The yield's now back up to 7.52% on a forward-looking basis. It was getting down to low 6%, which is why I was like, I have other high-yield opportunities that are growing more reliably at a high rate. But now it's trading at roughly 10 times earnings and growing reliably low single digits, returning most of the cash to shareholders via dividends. And this has been a long-term dividend grower, 10-year CAGR, 6.49%, 3-year CAGR, 4.09%. It is sustainable based on earnings per share and free cash flow. So I retain my position that Altria Group is one of the best high-yield dividend stocks you can buy, but you gotta know what you're buying it for and not to chase it at higher prices. My yield on cost for Altria is 10%. I'm probably not going to buy this again until it gets up to the high 8s or 9%. And that's the thing with the lower growth companies or high yield stocks that are lower growth. You have to be very careful with your buy price. All of the money is made in the buy. With that said, that's an updated look at my long-term dividend growth stock portfolio. If you want to use the earnings tool I showed throughout, it's available at Earnings Hub, link in the description and pinned comment of the video. Make an account so they know we sent you, and subscribe to the channel so you can see future portfolio updates and stock analysis videos. I'm so excited to share in the next few weeks the biggest update ever for dividenddata.com. It will be very exciting. Head over to dividenddata.com and make an account so that you can be updated when this news comes out. With that said, thanks for watching, and I'll see you in the next video.